So with a GDP of $29 trillion and a currency that is known as the world's reserve currency, the U.S. economy is the most important in the world. As someone says, it's the locomotive that drives the world's economy. And so goes the saying that when the U.S. sneezes, the rest of the world catches cold. After months and weeks of anticipation, the U.S. Federal Reserve finally cut interest rate by 0.5% last week. What impact will this decision have on you, your investment, and the economy in general? On this episode, I'm here to talk you through what you should do and, in fact, what you should not do as we digest this decision by the U.S. Federal Reserve. This and more on this episode of Market Take. Good morning, good afternoon, good evening, depending on where and when you are hearing me from. Again, it's Monday morning, and I'm here to bring you up to speed with events in the Nigerian and global capital markets. I strive to do this every Monday morning to make sure that you don't miss any information you need to make the most of the Nigerian and global capital markets, and in fact, the economy in general. To make sure that you don't miss any of my episodes, take a pause and subscribe and hit the notification button. As always, before I get into the show, this disclaimer that this show is for information purpose only. Nothing said on this show should be construed as an investment advice or a solicitation to invest in any security. Investing comes with different degrees of risk, and you want to make sure that you have professional guidance to take into account all the due diligence that is needed before investing. For a detailed description of my disclosure and disclaimer documents, go to the description segment of all our podcast channels, whether it's on YouTube and Spotify. All right, so to the business of the day. After months and weeks of speculation, the U.S. Federal Reserve finally cut interest rates by 0.5%. So currently the federal fund rate, which is the equivalent of what we have as MPR, monetary policy rate in Nigeria, and that is the rate at which banks lend to one another on an overnight basis. So the U.S. cut down this rate by 0.5% from 5.5% to 5% currently. As at 2022, this rate was at 0.25%. But with inflation becoming an issue globally from 2022, after the invasion of Ukraine by Russia, that sent energy prices and food prices soaring all over the world, the US, along with other central banks, started to raise interest rates. Between 2022 and July 2023, the US Federal Reserve had raised rates by 11 times from 0.25% to 5.5%. Now, as of July 2023, rates had gotten to 5.5%. But at that point, inflation was still very high, higher than the benchmark for the US Federal Reserve. The US benchmark for inflation is 2%. Inflation was still very high. So the Federal Reserve paused rate at 5.5% for over a year, from July last year to September this year. Rate had stayed at 5.5%. Now, what the Fed was waiting for was to see that inflation comes down lower to the target level, and that the economy remains strong while they were waiting. So up till August, it appeared that the economy was stable and growing. I mean, the U.S. economy was growing, is currently growing at about 3% on a year-on-year basis. So the Fed was comfortable up until August this year, when we started to see some weakness in the labor market. The economy added 142,000 jobs in August, lower than expected. Unemployment rate, not too bad, but was at 4.2% as of August. And at that point, the inflation had also come down, right, to 2.5%, closer to the Fed's target. So there was some expectation that finally the Fed will start to cut interest rate. And most analysts predicted a rate cut of about 0.25%. What the Fed did eventually on the 18th, last week, I think around last week, Wednesday, was to cut rate by 0.5%, which was not surprising, but it kind of sent a signal that the Fed must believe that the economy was weaker than many people thought, because if they went faster in terms of the amount of rate cut to implement, it must mean, I guess this is what the market felt, it must mean that the Fed believes that the economy had some level of weakness that needed them to act with more urgency to stop the economy from going into a recession. So we saw a 0.5 rate cut. Now, an interest rate cut means a lot, not just to the U.S. economy, but to the global economy. Starting with advanced economies, when you see a rate cut like this, it means that interest rates, you expect rates to go lower, whether it's rate on bank facilities, the rate at which, of course, the Fed fund rate is the rate at which banks lend to one another. So if this rate starts to go down, then the rate at which banks will lend to their customers should also start to go down. So we expect to see lower rates on mortgages for people who have homes abroad. On mortgage, you're going to start to see the rates come down gradually, especially as the Fed steps up this rate cut. The expectation is that when they meet again in November and December, we're going to see 0.25% rate cut, which should bring interest rate at the end of the year to about 4.5%, which is a good news for people with credit card, mortgage loans, but bad news for savings account holders, because rates on savings accounts will drop in these economies. Of course, when you have this scenario where rates are much lower, investors will have an opportunity to borrow at much lower rates. You expect to see more borrowing to invest in asset classes, whether it's real estate, even cryptocurrencies. I think there's a lot of excitement in the crypto market following this rate cut by the Federal Reserve. So the expectation is that there'll be more access to funding. Investors can get these funds and invest in diverse asset classes. So this is where all of this excitement is coming from in terms of the interest rate cut. But for a country like Nigeria, bringing it down home, we have three major expectations from this rate cut. First being that there's expectation that with an interest rate cut, you're going to have more access to funding, and this should percolate into the economy. You have more companies having access to funding, and that should drive economic growth, especially at a time where we're seeing weakness in China. So you don't want the U.S. economy going into a recession. So if the Fed manages to get the U.S. economy to avoid a recession, it's good news for the rest of the world. You're going to see better demand for oil as economic activity ramps up in the U.S. and these advanced economies. Again, you saw the impact this had in the oil market last week. Brent crude went from about, I think around 70 at the beginning of the week to $74 per barrel at the close of the week. So it's also exciting for a country like Nigeria that revolves around the price of crude oil. So that is on one hand. We expect oil prices to go up, which is good news for Nigeria. On the other hand, again, you expect that if you have lower rates in these advanced economies, you start to see rotation of capital out of these advanced economies to emerging markets like Nigeria. We should strengthen our currency as these capitals find their way into the Nigerian market. And again, this is theoretical, I must say, very theoretical. It's an assumption that if the rates are lower, And I'll get to what I'm saying is theoretical. Also believe that you have more foreign portfolio investors looking for higher returns, and that should drive them into the Nigerian equities market, our fixed income market, leading to higher stock prices. Already, the Nigerian stock market has been tremendous in the last since 2023. Last year it did over 40%. This year is year to date 31.4%. So the expectation is that as you see capital rotate from developed markets to the emerging markets, where we have Nigeria, you start to see even better returns from the Nigerian stock market. But I say that this is theoretical for a couple of reasons. First of all, you have to understand that the level of interest rate coming into 2022 was 0.25%. So for an average US investor, whether it's the current rate, which is 4.5%, or the target at the end of the year, 4.5%, or even, before we get to 3% interest rate in the US, that will be well into next year. So for an average US investor, 3% is still high relative to 2020, when we had near zero interest rate. So it's not automatic that because we've seen a 50% interest rate cut, it's not automatic that you're going to have capital now rushing into the country automatically. So this will take time. It will take time, maybe the next 1 year or more, before we start to see real outflow from the US economy. But then, even when the capital starts to go out of this developed market looking for better returns, there's competition within the emerging markets. Currently, today, the most attractive destination for people who want to, foreign investors, international investors looking for higher returns in the emerging market, the most attractive destinations today is currently Brazil, India, China, Mexico, the likes of Singapore. Somehow Nigeria has fallen off from these attractive destinations, for obvious reasons. And even when you come to sub-Saharan Africa, you're looking at countries with better GDP growth, better economic growth, like Senegal today, Niger Republic, Ethiopia, and even Libya. These countries are doing better in terms of economic growth. Nigeria is growing at about 3-point-something%. So in terms of countries seeking better returns outside of the developed market, Nigeria may not be as attractive as it used to be in this past. But obviously, Nigeria is always in this conversation because of our population. With a population of over 200 million people, untapped potentials in mineral resources, Nigeria will always be in the conversation. But we obviously have to do a lot more as a country to make the country remain an attractive destination. So my point being that the rotation of capital out of these developed markets into emerging markets is not automatic that Nigeria will remain attractive as we used to be in 2008, between 2008 and 2014. It's not automatic that the country will remain attractive as it used to be. However, there is a lot of optimism, especially from the reforms that have been instituted by this present administration. So as these reforms start to bear fruit, as the authorities become prudent with their fiscal policies, maybe we'll start to see some rotation, but it's obviously not automatic that we're going to start seeing these FPIs flood into the country because of this interest rate cut. One, it will take time, and even when it starts to come, there are competing economies for these funds to come in. Now, in terms of what we're seeing from the Nigerian market, the impact is kind of mute from what we saw in the market last week. The all share index went up by 0.8%. Year to date is 31.4%. Obviously, the markets have priced in this rate cut, even though one can argue that it was higher than anticipated, judging by the fact that we had anticipated a 0.25 and the Fed came out with 0.5%. But most of that had largely been priced into the market. So we didn't see much reaction from the market other than the first day. I think the first day the policy was announced, we saw a strong bullish run in the S&P 500. But the very next day, as the market started to digest this information, that started to moderate. So the S&P 500, I think, returned about 1.4% for the week. The Nigerian stock market did 0.8% for the week. But by and large, the Nigerian market is still very much undervalued. Very, very much undervalued. Just because we don't have a lot of foreign portfolio investors that used to make the market very thick. And of course, the institutional investors kind of dried up a bit. And obviously, the retail segment is not there to support the market. So you continue to see a high level of volatility in the stock market. So in terms of what you should be doing as an investor, I think what I always advocate is to have a long-term outlook. Focus on very resilient companies that can withstand and weather all the storms that comes with the Nigerian market. Operating in the country has become somewhat very difficult, with the exception, of course, for the banks. The banks have been thriving, especially with the FX policies. It's favored the banks largely because most of them have net positive foreign asset positions, and they get to revalue this asset as the naira continues to get devalued. They keep revaluing this asset at much higher rates. So the focus for me will be on these companies that are resilient, very resilient companies that have leadership in their industries. You look at sectors like telecommunication. It's one sector I'm still very, very much interested in terms of the fact that, telecommunication is basically MTN and Airtel in that industry. Then, of course, the industrial goods, just these companies with strong pricing power and then strong demand for their products. So the focus should be on such companies that can weather any storm that comes with the Nigerian operating in the Nigerian territory. In terms of the fixed income market, we saw yields came down slightly in the bond market. That was largely because of, I think, about 400 billion came in as coupon payments for the federal government bonds. And of course, the investors will find a way to reinvest these monies back into the market. So that kind of sent the average yield lower a bit for last week. I don't really think that the slight decline we saw in the average bond yield was a result of the announcement by the U.S. Fed. Obviously, we had over 400 billion coming as coupon payments for FGN bondholders last week, and a lot of those monies were reinvested in the market. So that kind of created a lot of demand that sent the market slightly lower for the week. The Treasury bill side of things, rates went up slightly higher in the Treasury bill market. So it goes to my point that it's going to take more rate cut. We need to see rate come down to around 3% for it to have significant impact on the Nigerian market particularly. I think last week we had some chatters from investors in the savings bond. I think the one issued in May or thereabout, the coupon was due 2 weeks ago, and investors had not been paid up until last week. And we had the DG of the Debt Management Office, DMO, say that it was a result of system issues which they were working on. I heard a lot of comments, bloggers talk of the government being under some sort of stress. Obviously for our debt service has been rising. For instance, in the first quarter, the Nigerian debt service was 2.4 billion, I think 2.4 trillion, compared to 1.4 trillion revenue that was generated in the first quarter of this year. Obviously it's something to worry about. But I do not think necessarily that is a result of the government's inability to pay, because I mean the savings bond market is a smaller market compared to, or the size of issuance in the savings bond market is nothing compared to what you have in the FGN bond market, and the government has, the DMO has been meeting this obligation over time. So I don't think, I want to believe that it's a system issue which should be resolved, but the DMO on this part needs to understand that having this sort of issues is not doing us any, will not do us any favor in terms of making the country very attractive. You don't want to hear this kind of conversation casting aspersions on the government's ability to meet its obligations. So it's important that they put their house in order and ensure that investors get paid as soon as possible. Because this retail market is also important in terms of image making. I don't think the DMO should take that market for granted, because it's become a very important source of funding for the government and even for the economy, because most of the people, the minimum investment for the savings bond market is 5,000 naira. And for many retail investors that have been excluded from the fixed income market, this is an excellent opportunity for them to make the most out of the fixed income market. And I think it's a good thing that the government did in 2017, and we should do everything we can to make sure that that segment of the market continues to thrive. And we have an auction, I think today, there's a bond auction holding today in the 2029, 2031, and 2033 maturities. So we'll see what the DMO will do in terms of the closing rates for these bonds. I think it will send a signal as to their thinking and how they assess the decision of the U.S. Fed. We also have the MPC, the CBN's Monetary Policy Committee meeting holding today and tomorrow. So by tomorrow, we'll hear what the central bank governor has to say in terms of their decision. But I think they are going to hold rates steady at 26.75%. Obviously, inflation has come down. The data we saw last week showed that inflation moderated from 33.4 to 32.15%. So we should see, I don't think the central bank will be under so much pressure to continue to raise interest rates as is done very recently. So I believe they are going to hold rates and see what happens next. But I don't think they are going to cut rate just yet. Cutting rates now may actually reverse or send rates a lot lower. And keeping rates attractive is important for them. I mean, the central bank has done well in terms of stabilizing exchange rate, because this is another thing that foreign investors will look at, foreign portfolio investors will look like. What is the stability of your exchange rate? And in the past couple of months, exchange rate has stabilized around 1.5, 1.6 band. So I think the central bank will want to maintain that. So I don't think they'll be in a rush to cut interest rates yet. They'll also not be in a rush to raise rates again. So I think they hold rates steady. We'll get to hear that by tomorrow when we hear the result of the MPC meeting. And then to the US market, if you go out and ask ChatGPT to make recommendations for you on stocks to buy, I guess ChatGPT is going to tell you to buy healthcare stocks, consumer goods. I mean, those stocks that are defensive, that thrive even when the economy is in recession. And the reason the ChatGPT will ask you to do this is, obviously, ChatGPT will give you a response based on historical evidence, what has happened in the past. Every time the US, most times in the last years, most recent years that US Fed cut rate, I think in 2008 and in 2016, the last time they cut rates, the economy was on the verge of a recession. You had very slow economic growth, not the level we have it today at 3% for the U.S. economy. Unemployment rate was very high, in those years. Obviously, we had the global financial crisis in 2008. So at that point, investors will flock to safety, healthcare, consumer goods that will do well irrespective of what the economy is doing. But the condition is a bit different today. The U.S. economy is growing at 3%. One can argue that unemployment rate is relatively high, but 4% is not a bad number for an advanced economy like the U.S. So the economy is doing relatively well, and even though we are seeing this interest rate cut. So unless the economy goes into a recession, investing in this type of stocks may not even be the best at this point in time. So personally, in terms of what I should be doing, what an investor should be doing now, I don't even feel the need to take any decision in terms of rotating to other asset classes, over the last couple of years. And typically, this is not even a time you should see technology stocks doing well. In periods of high interest rates, you won't see technology stocks doing very well in such periods. But the reverse has been the case. The stocks that has been driving the stock market lately has been the technology stocks, the Magnificent Seven, the cloud security stocks, cloud computing firms, and all of those companies. They have been the ones driving the market lately, which is a kind of reverse to what should be happening in periods of high interest rates. So it's kind of like it's a bit tricky trying to decide how to allocate capital at a time like this. So for me, I'm really not doing anything other than sticking with my long-term plan, my long-term approach to investing, which is to keep investing in in the companies that have leadership in their industry, and then choosing investment teams that I believe will do well going forward. So in terms of how to play the current market, personally, I don't even see a need to adjust my personal portfolio other than to stick to my long-term strategy, which is to focus on particular investment teams and identify firms along those teams that dominate and have leadership potentials or that are leaders in such industries. Obviously, a lot of portfolios are skewed towards technology stocks, so you want to look at your portfolio, if that is the case, to kind of diversify a bit away from the concentration in technology stocks. Obviously, we've started to see some rotation away from technology stocks, but I don't really believe that we're going to see massive rotation from technology stocks, because obviously the AI thing is still very much in play. It's still early days in terms of how much revenue growth some of these companies are going to see coming from artificial intelligence. So I'm not going to aggressively start to diversify away from technology stocks into all these other sectors like small caps and maybe healthcare, utilities, and all of those sectors. I think the goal is basically to have a more balanced portfolio, have a more balanced allocation to all of these segments. Now, if you look at the performance of the market for last week, the small cap stocks performed better than the S&P 500. Small cap did 1.7 compared to S&P 500 1.3. But like I said, I don't really think that this will be the story of the market well into 2025. Corporate outlook for corporate profit is still very strong going into 2025. Companies are expected to even perform better than they did this year in 2025. So for me, it's to be careful and stick to your long-term investment strategy. One of the firms that did well last week is GameStop. GameStop is one of these companies that has become very attractive for meme investors. So you're going to start to see this happens over and over. You're going to see some of these companies that are really not growing revenue, really not doing anything in business in the business sense. They're really not moving the market business-wise. But you're going to see somehow that retail investors are going to pile into these stocks and send the prices high. So my word of caution will be careful. If you're a bandwagon investor, you're going to see a lot of bandwagon investing going forward as this rate cut starts to take hold. In terms of the companies that I'm looking at this week, I think two of them, Constellation Energy and Costco. Constellation Energy, first of all, is into renewable energy. There's a lot of talk about artificial intelligence and the data centers that power artificial intelligence, and the fact that these data centers are power hungry. They need a lot of energy to run. Constellation Energy is one of the companies that have been identified as front runners to kind of support these AI firms in terms of providing power to run their data center. Last week, they, I think, resigned I'm not sure what it is now, whether they resigned an agreement or reactivated an existing agreement for Constellation Energy to build a nuclear power plant for Microsoft, to power their data center, and that kind of sent the price rising last week. I think for the week it did about 22% last week. It's one of the best performing companies on the S&P 500 this year. Constellation Energy is one of the best performing companies on the S&P 500. Year to date is done 119%. But my concern about the firm is that we've not started to see the impact of energy demand on revenue growth. But maybe as we see a stronger economy, as we see the economy growing at a higher pace, as interest rate comes lower and economic activities pick up, we're going to see more demand for energy, and it should show up on their revenue growth. But their long-term revenue growth is not at the level that personally I want to see. It is 4.04%. The revenue, quarterly revenue year on year is 0.53%. But however, the EPS growth is better, 34.6%. Debt to equity ratio is not bad. Return on assets, decent, 20.53%. Sorry, return on equity, 20.53%. And then return on assets is kind of low. It's weak for me, 4.79%. So I'll see how the company performs going forward. But it's definitely a firm that I want to keep track on. I have some of it, but certainly I'm not buying more at this point. I want to see what happens in terms of how they take advantage of the opportunities that we have with these data centers. Then the other firm is Costco. Costco is another firm that I own. They've done well this year. They are reporting their Q4 fourth quarter earnings report comes out on 26th. That will be around Wednesday or Thursday. Their Q4 report is coming out. Costco operates about 600 warehouses in the United States and controls about 60% of the retail warehouse market. Obviously, so what they do is they have these warehouses where you can go buy practically anything that you need. And then for you to shop there, you have to pay a membership fee, which contributes to a significant portion of their annual revenue. Very important source of revenue for them. So what the membership fee does for you is that it gives you the right to buy and shop at their outlets at discounted prices. And their discount is so much that competitors find it difficult to cope. Obviously they have superior cost management strategies. So they have over 600 warehouses in the United States and about 270 outside of the United States internationally. They have warehouses in Canada, Mexico, United Kingdom, and Japan. They will be reporting later this week. So one of the knocks on Costco recently is that the share price has gotten to a very expensive level. Currently at I think 903, it closed last week. And that is a price to earnings ratio of 56, which is much higher than the average market PE ratio of 28. So a lot of investors will consider it very expensive, but the company continues to grow revenue, not at a very high pace, but at a very steady pace. Their 5-year revenue growth is 11.34%. Quarterly year-on-year revenue growth is 9.07%. So for a mature company like Costco, these numbers are very decent. Their return on equity is 30.5%. Costco will be reporting their fourth quarter earnings, presenting their fourth quarter earnings report to the market. So by next week, Monday, I'll be here to walk us through the report and tell you what I see from that report. And this is where I call it a day on this edition of Market Tape. My name is Nathan Casey Nwokoro. Don't forget to subscribe and activate the notification button so you never get to miss any of my shows.